Wall Street is asking a multi-billion-dollar question this week. Can the massive spending on artificial intelligence finally turn into massive profits? With capital expenditures for 2025 hitting $88.2 billion, Microsoft is signaling that 2026 will be even more expensive. As the company prepares to open its books, investors are nervous. Is this the start of a nuclear renaissance for data centers or a bottomless pit of spending? The market's reaction to this week's earnings could define the entire tech sector for the rest of the quarter. Welcome to TickerWatch News from Microsoft, Week 4 of 2026. In this episode, we break down the critical developments surrounding the Redmond tech giant as it faces one of the busiest weeks of the year. From the snowy peaks of Davos to the trading floors of New York, the focus is squarely on cloud capacity, energy costs, and whether the AI boom can sustain its momentum. Looking at the recent performance, Microsoft has seen some turbulence. While the company has outperformed the broader software industry over the past 12 months, gaining roughly 2.3% against an industry decline, the shorter-term picture has been weaker. Recent analysis indicates that the Magnificent Seven cohort, which includes Microsoft, has trailed the S&P 500 since late 2025. Specifically, Microsoft has been described as particularly weak leading up to this earnings cycle, lagging behind peers like Apple and Tesla. Broader market futures have been flat to trending downward early this week, influenced by geopolitical tensions and anticipation of the Federal Reserve's rate decision. The tech sector in particular has faced pressure as the dollar weakened and Treasury yields fluctuated. Investors appear to be in a wait-and-see mode, hesitating to push the stock higher until they see concrete numbers regarding cloud growth and capital spending. There are three major stories dominating the narrative for Microsoft this week. First, the spotlight is on the fourth quarter earnings report. Microsoft is scheduled to report results this Wednesday after the closing bell. The expectations are high. Wall Street analysts are forecasting earnings of $3.88 per share on revenues of $80.2 billion. If hit, these numbers would represent year-over-year growth of roughly 20% for earnings and 15% for revenue. The revisions trend leading up to this report has been positive, with analysts steadily moving their estimates up for both the December quarter and the full fiscal year. Second, the debate over capital expenditures and AI infrastructure. The cost of doing business in the AI age is skyrocketing. Microsoft CFO Amy Hood has previously stated that the company expects to spend more in 2026 than the $88.2 billion it spent in 2025. This massive outlay is driven by the need for data centers and chips. At the World Economic Forum in Davos earlier this week, CEO Satya Nadella emphasized that energy costs are becoming the deciding factor in the AI race. He noted that winners will be determined by who can produce cheap energy and build data centers effectively. He even referred to tokens as a new commodity, stating that the job of every firm is to translate these tokens into economic growth. Third, capacity constraints in the cloud. Despite the heavy spending, there are warnings that supply cannot yet meet demand. Strategists at HSBC Bank noted that the three largest Western cloud players, Amazon, Alphabet, and Microsoft, are all facing capacity constraints. There are strong backlogs, but long infrastructure project build times mean these bottlenecks are unlikely to resolve quickly in 2026. This creates a challenging dynamic where demand is high, but the physical ability to serve it is limited by how fast pipes and power can be brought online. Investor sentiment right now can best be described as cautious optimism. On one hand, institutional analysis remains bullish. Microsoft's Azure platform holds a strong 25% market share, and the company generates operating cash flows exceeding $100 billion annually. However, a shift in sentiment is visible regarding the AI trade. Wall Street is becoming skeptical of the hundreds of billions being poured into infrastructure without immediate massive returns. Wells Fargo's chief investment officer recently noted that big tech has become a show-me story. The days of beating estimates by 1% and promising future growth may be over. the market now demands evidence of accelerating growth and return on investment. This skepticism was highlighted by the market's reaction to other tech giants recently, when Meta projected larger capital expenditures previously without detailing the profit path. Its stock was punished significantly. Investors are watching Microsoft to ensure it doesn't fall into the same trap of promising spending without showing the receipts. Fundamentally, the valuation picture is complex. The Magnificent Seven index is trading at about 27 times expected profits over the next 12 months. While high, this is roughly in line with the 10-year average. Microsoft specifically is trading at a premium to the broader market. The balance sheet remains a fortress, but there are items to watch. Long-term debt stands at around $43.2 billion. In an environment of fluctuating interest rates, this debt load combined with the need for massive infrastructure spending puts pressure on financial flexibility. Technically, the stock has been moving sideways to lower. The Magnificent Seven index peaked in late October 2025 and has retreated since. Microsoft shares have been lagging the broader market recently, struggling to find momentum amidst the AI bubble debates. The critical support levels will likely be tested depending on how the market digests the cloud revenue numbers. The key metric to watch here is Azure growth. In the fiscal first quarter, Azure revenue rose 39%. Wall Street is looking for 36% growth for the fiscal second quarter. Any miss on that number could break technical support. Looking ahead, the immediate future of the stock hinges on the Wednesday earnings call. Investors should listen for three specific things. 1. Azure growth. Does it meet or beat the 36% expectation? 2. Copilot adoption. Are customers actually paying for the AI upgrades in Office and Windows? And 3. The CapEx guide. Exactly how much higher will spending go in 2026? Beyond earnings, the Federal Reserve's decision on Wednesday is a major catalyst. While markets expect rates to hold steady, any commentary from the Fed regarding inflation or future cuts will impact high-growth tech stocks like Microsoft. Finally, watch the infrastructure narrative. With reports of backlog issues for turbines and power grid equipment, pay attention to any announcements regarding nuclear energy or new power deals. With the administration pushing for a nuclear renaissance and data center operators bidding for power contracts, Microsoft's ability to secure reliable energy is a key long-term differentiator. To recap the situation for Microsoft this week, earnings are imminent. The company reports Wednesday after the close, with analysts expecting roughly 20% earnings growth and 15% revenue growth. Spending is rising. CFO Amy Hood has signaled 2026 spending will exceed the $88.2 billion seen in 2025, raising the stakes for return on investment. Cloud constraints persist. Demand for Azure is high, but physical infrastructure and energy availability remain bottlenecks. Valuation premium. The stock trades at a premium to the market, meaning execution must be flawless to avoid a sell-off. That wraps up this week's analysis for Microsoft. Thank you for tuning in to TickerWatch News. As a quick reminder, this podcast is for educational purposes only and does not constitute financial advice. The market is volatile, and you should always do your own research or consult a professional before making investment decisions. If you found this breakdown helpful, please subscribe and share the episode. We'll be back next week to break down the earnings results and what they mean for your portfolio.